What if I told you there were investments that the rich invest in that the poor and middle class do not? Would you be interested in knowing what they are? In this video, we're going to talk about some of the investments that the rich make that the poor and middle class don't. Now, before you go ahead and write this off as being something only for people with a lot of money, hear us out. These investments can be made with very little money and can provide a big return on investment. So whether you're just starting out or you've been investing for years, we think you'll find this video helpful. Investing in assets rather than liabilities. In the long run, investing in assets rather than liabilities is far better for your financial stability. Smart investment choices can lead you to an affluent retirement. However, it is important to understand your risk profile and unique circumstances when making an investment decision. There are many ways to turn your liabilities into assets. You can sell the assets that are not performing well or donate them. In order to grow, companies need more assets than liabilities. If they have more liabilities than assets, they can't pay their debts and will face financial trouble. However, if the business has an adequate amount of assets, it can finance growth. For example, it can buy new tools and equipment for its operation. The trick is to make sure that the liabilities don't increase faster than the assets. Investing in businesses. If you want to make money in today's society, investing in businesses the rich don't invest in is an excellent option. The U.S. stock market has seen a record high since the Great Recession hit in 2009. However, the gap between the rich and the poor is widening. The rich are more likely to have a large portfolio and invest it. Investing in a business can be very exciting and rewarding, but it can also be risky. Depending on the idea or product, you could make a large profit or lose a lot of money. If you have the knowledge and experience to understand the business, you can minimize your risk. Also, you can get advice from people who have been in the same position as you. Before you make an investment, it is important to review the finances of a small business. It is also a good idea to do a background check on the owners and leadership of the company. You should also ask questions regarding the valuation and frequency of returns. Finally, you should ask the company to explain how much money it is currently making and how much money it is generating. When investing in a business, you should know that it is important to have sufficient reserves to cover operational expenses. The amount you invest should be enough to cover the costs of running the business and other investment opportunities. Furthermore, you should know that 1/3 of all small businesses close within 2 years, so the risk of losing your capital is real. That is why you should only invest money that you can afford to lose. While investing is risky, it also provides a way for entrepreneurs to raise funds. Although it may be risky, there is a high expectation of a positive return. In contrast, gambling is highly risky and has a low or negative return. Before we continue in this video, let's take a quick pause. If you have been enjoying this content so far, please give this video a quick thumbs up and subscribe to our channel as well. Make sure to stick until the end to know more on what the rich people invest in, that most middle and poor people don't. Investing in hedge funds and mutual funds. Hedge funds are private pools of money that are managed by financial professionals. They invest in securities and financial contracts, and make extensive use of sophisticated trading and portfolio construction techniques. They are often referred to as hedge funds or proprietary funds, and their marketing is limited to accredited investors, high net worth individuals, and institutional investors. Hedge funds are more aggressive than mutual funds, and typically seek to make higher returns for investors. They are regulated differently than mutual funds, and are only open to accredited investors. Investing in mutual funds can be less risky, because most of them do not depend heavily on derivatives and alternative investments. In addition, mutual funds can be more suitable for the mass investing public because they do not require investors to hold a high amount of risk. Meanwhile, hedge funds are privately offered funds that are known for their higher risk positions and may utilize leverage and short selling. While many wealthy investors invest in hedge funds, many of them don't understand the nuances of financial markets. According to a recent survey, the top 1% of American economic units owned nearly 3/4 of all financial accounts holding stocks. Moreover, the top 10% of earners controlled 84% of Wall Street portfolios. While the vast majority of hedge fund managers outperform the market before fees, there are also some risks that should be taken into account. Because of this, hedge fund investors must have a thorough understanding of the strategy and governing terms of the fund they choose. Hedge funds are not subject to the disclosure requirements of mutual funds, and investors must read the documents carefully to determine the risks involved. Investing in real estate. The rich understand the risks associated with real estate investments and manage them accordingly. For example, they don't gamble with their money and make sure they get the right insurance coverage. They also do not start new businesses without researching their profitability. This is a key reason why the wealthy are more financially literate than the average person. In addition, they also understand how to invest. In addition, the rich know how to allocate their money wisely. They invest in real estate, art, land, and other tangible assets. Despite the risks involved, real estate remains a popular asset class. It balances out the volatile stock market. The low liquidity of physical assets often scares away small investors, so the rich are more likely to invest in these assets. Real estate investments are not for the faint of heart. Traditionally, returns on real estate investments have lagged behind inflation. However, in recent years, real estate prices have been rising rapidly. Despite this, real estate investments still don't generate high returns. For most people, real estate investing is a form of investing that allows them to retire early. In addition to high transaction costs, real estate is also risky. Those with a stable income can avoid the risks associated with real estate by having a diversified portfolio. This ensures that their investments are protected even during a downturn. Investing in precious metals. Investing in precious metals is a lucrative investment strategy, but it carries unique risks. Investors must assess their risk tolerance, understand their goals, and determine their risk profile. Investing in precious metals can either result in massive wealth accumulation or devastating losses. The value of precious metals was recognized by ancient civilizations. Even today, these metals remain valuable commodities. They are an excellent hedge against inflation, are relatively safe, and have a long history of serving as stores of value. However, investing in precious metals may be risky if the dollar is in the tank or inflation spikes. Investors must carefully consider the risks associated with gold investing. If the dollar falls or inflation spikes, it could make the investment unprofitable. The price of gold and silver is relatively stable, and gold is often cheaper than silver. Silver is also an excellent hedge against inflation. Silver has been a store of wealth for thousands of years and is used in countless industrial processes, including the manufacture of electrical control units. Silver also has hedging qualities, which means silver miners are well positioned to benefit from a rising silver price. Examples of such companies include Pan American Silver, Wheaton Precious Metals, and First Majestic Silver. Have you ever invested in one of the things we have already discussed in this video? If yes, what are those, and how is your experience in handling those? If you still cannot find anything that fits your type, maybe this next one is the one for you. Investing in collectibles. Investing in collectibles may sound like an exciting investment, but it's not without risks. There's no guarantee that you'll get your money back, and there's no guarantee that you'll sell your items for more than their current value. There are also a number of unexpected challenges that you may face along the way. Knowing these risks and how to mitigate them will help you invest smarter. Collectibles may not be as liquid as other types of investments, but they can hold their value in the long run. They can appreciate in value, especially in economic downturns. The value of collectibles depends on demand and supply, and some collectibles increase in value with age. Famous examples include art, coins, vintage automobiles, and baseball cards. Even old photographs can turn into valuable investments. In a UBS Investor Watch survey, a quarter of wealthy investors said they had built collections, which represented 10% or more of their overall wealth. The majority of these collectors had been building their collections for 20 years or more, and many had a passion for the objects they collected. However, the majority of collectors said they had never sought appraisals, and almost half didn't insure their collections. Investing in collectibles is not a good idea for the uninitiated. Collectibles require special care and handling. The best way to protect your investment is to get expert advice. You can contact reputable dealers who will help you choose the right type of items to buy. It is also important to know what kind of insurance you should buy. The last thing you want is to end up with a collection of valuable items that you can't sell. In this video, we discussed Rich Dad's Guide to Investing. What the rich invest in that the poor and middle class do not. If you enjoyed this content, please consider subscribing to this channel and sharing the video. You would also enjoy this next video.